All right. Well, let's get started. Hello, everyone. Thanks for joining today. We have with us our newest carrier partner, National Guardian Life. My name is Kristie Strauss, and I'm the Vice President of Sales at Insurance Advisors Direct. And if those of you did either live stream or listen to our summit or were in person at our sales summit, I did a little segment there on long-term care and why I feel like it's a really good time to start having that conversation with your clients right now in Michigan. Larry Moore is the presenter today, and he is the Regional VP of Individual Products at National Guardian Life. He's going to tell you all about this great long-term care product and why it is a good time to start having that conversation. We're here to help you with that sale, and we want you to know that it is a very important and critical product that all ages should know about now, and it's time to get them started. So Larry, I'll just kick it off to you and let you take it from here.
All right, Kristie, thank you very much for having me, and good morning, everybody. Yeah, there's a lot of interesting things going on in the long-term care realm these days, and Kristie just touched on it with regard to the state of Michigan. And while we don't know what's going to happen with the state of Michigan, they're following the path of Washington State. And California and a handful of other states are doing the same thing, where they will mandate long-term care insurance through a tax for employer groups, basically for people who are at work right now. And I can tell you that while we don't know what's going to happen in Michigan, probably not for another year and a half or so, what I can tell you is that in Washington, it was a scramble because people in general, once they started to figure out what the Washington state plan might look like and what their private alternatives actually were and are, they scrambled to get private insurance because it was such a superior solution. And they helped them avoid paying the tax, right? So again, we don't know how it's going to unfold in Michigan State, but it's a great opportunity to have a very open, non-pressured conversation about long-term care planning while your clients and prospects have the ability and the luxury of time to make the right decision for themselves. And if they go with private insurance right now, great. If the state program is so much better, they can always drop what they bought or modify it to fit within what the state plan might be, right? But it's a great opportunity to have a conversation ahead of the chaos that may ensue in the state of Michigan if this ultimately happens, and it looks like it will, right? But not enough on that. Let's talk about National Guardian Life and the 4 reasons why. And let me give you a little bit of my background because that'll add some perspective in what I'm going to share with you. I've been in this industry for going on 34 years now, just a little over 33 years, going into my 34th year. I've seen a lot. You all probably have seen quite a bit yourselves. Major carriers have left the marketplace. And I'll tell you, a lot of the premium instability that we experience in this industry were from major, highly rated carriers who just didn't fully understand the long-term care risk profile. They just didn't. Nobody had enough experience to know. Now we do. So when we talk about National Guardian Life, this company is better positioned than any company we compete against in terms of exposure. So I'm going to talk about that. When we talk about the best of both worlds, what do we mean by that? Well, in my eyes, sometimes it's great to be late to the dance, right? We've been in this marketplace since 2016. And if you kind of reflect back on what the interest rate environment was like, the Treasury was actually near zero, right? The interest rate environment was horrible. It was a tough time for insurance companies. And that is the market that we were priced for. And witness where we are today with interest rates, right? So we're priced with incredible profitability right now simply because of when we enter the market. We also are utilizing the most conservative and up-to-date morbidity and actuarial standards. So from a profitability standpoint and from a long-term stability standpoint, we could not be in a better position. Our balance sheet is clean. We only have 2 active claims, right? So again, no carrier is enjoying the position rehab. They can't if they've been in it longer than we have. So from that being said, what do I mean by the best of both worlds, right? Well, we're an old company. We're over 110 years old as an insurance company, but we're a baby when it comes to the LTC market. We've been in it since 2016. So ultimately, people ask the question, well, you've only been in for since 2016, do you know what you're doing? Well, from a financial position, we're in great shape. We were able to, because of our financial position, provide some unique features competitively priced that other carriers simply can't. So I'm going to talk about the unique features that really matter. As you notice, the 4 reasons why on our cover slide, that's where I'm going to focus on. And then ultimately our worksite capability as well. So let's kind of get right down to what we're talking about with the best of both worlds. Solid ratings. We're an excellent company. We're working on getting our 2nd rating. And I want to stop right on ratings right there, because sometimes financial advisors in particular are concerned about ratings, as they should be. And that, wow, we only have 1 financial rating. Is that a bad thing? Well, let's think about the highly rated carriers with multiple ratings who are in this market that have exited. MetLife, CNA, John Hancock, Prudential, like Genworth. I can go down the list, right? Ratings are important up to a point. But when you look at our situation, just focus on our balance sheet and suddenly you think, wow, these guys are in a big position. We're not small, but we're not huge either. 4.7 billion in assets, a little over 1.27 million policy holders. So that's the company. But then you may ask the question, well, if you only been in this for such a short period of time, do you understand how to pay claims? Do you understand the back end of the business? And that's why we have partnered with a third-party administrator called LifeCare. They handle our back office, right? This is all NGL, but what they bring to the table is over 30 years of experience and wisdom in the area of pricing product, designing product, and paying claims. So paying claims on hundreds of millions of dollars of cases like that. So that's the beauty. We stick to our knitting. We know where we are as a carrier. We want the expertise of a TPA who knows this market really well. And I will tell you from my own experience, I feel very fortunate that we're working with LifeCare, because when you have problems, I can actually go and intervene and talk to people, and actually you can too. So that's the great thing. That's our company story, and I'm taking that to the bank. So that's the number 1 reason, right? The best of both worlds. Let's look at 2 and 3 for a minute there. 2 and 3, reasons 2 and 3 have to do with our product as it's built for couples. We have a joint policy for couples, and it's a very unique pricing structure for that. So, and the key word's couples. It doesn't mean traditionally married people. It could be domestic partners. Anybody in a committed relationship sharing a residence together, that's a couple, right? And the beauty of how we structure our joint policy is each individual will have their own benefits. The benefits will happen to be identical to each other's, but they'll have their own benefits. So in our joint policy, if insured one were to exhaust his policy in this example, he's not going to be able to invade insured number 2's or the spouse's benefits. Those are hers. So we protect each other's benefits in our joint structure. So the question is, do we have shared care? And the answer is, we do, but we do it better than the others. And I'll talk about that right now. With shared care, it's not an expensive addition. You're adding a 3rd pool of benefits that reflects the exact value of the policies of insured 1 and 2. So if insured 1 and 2 have a 3-year, I'll call it a $400,000 pool of money, then the shared benefit amount, that 3rd policy be the same 3-year, $430,000 benefit. And each of them can draw from that. So you can see that in a shared care situation where my competitors will allow insured 1, for instance, once that person exhausts their benefits, to then invade the benefits of his spouse or partner, ours is different. You draw from the pool of money. So if insured 1 goes on a claim and exhausts, in this case, his policy, he can then draw into that 3rd pool until he passes away or the claim ends and either uses it up or there may be some remaining for the survivor, right? And if insured 2 goes on claim, she can use it up. Now, here's what's interesting about how we do this. Obviously, it's a rider. You pay a cost for that. Let's just say that insured 1 never claims and then dies, leaving the survivor who would inherit that 3rd pool. She can make a decision to either keep it or if she wants to save a little premium, she can drop the rider. Also, what's important to keep in mind is that with the joint policy, if one insured were to pass away, the premium will drop to reflect the remaining survivor. You're not paying for 2 anymore. So let's kind of look at this from kind of a pricing standpoint to give you a sense of what this looks like. So obviously NGL's on the right side. Our key competitor on the traditional side, this is traditional long-term care insurance, is on the right side. And you know, when I look at the products you all have access to, you've got great choices through your agency, right? You have asset-based products, which I personally love. I like asset-based products. You also have traditional products, which always give you more leverage for the premium dollar. And that's an important trade-off. If you're looking at pure risk management, it's hard to beat the efficiency of traditional long-term care insurance. But what we're showing you here, if you look on the left side, that's us. This is an example of a 3-year, $200 a day plan for insured 1 and 2. So insured 1 and 2 each have $219,000 each of benefits. That's their lifetime maximum. And then for 28% more premium, they've added the shared benefit amount rider, which brings another $219,000 into the equation that they both have access to. So in a sense, from day one, this couple shares $657,000 of tax-free liquidity to pay for their long-term care. And an annual premium, these are based on Nebraska rates, which reflect Michigan rates as well, $6,300 a year. Now let's look at my competitor. Happens to be a well-known company, happens to have a lot of experience with exotic animals and wild game, right? You probably know what I'm talking about. They're our key competitor, fine company, great product of their own. But when you look at how we can structure our shared care to their shared care, you're paying more premium ultimately for less purchasing power. You're paying almost $1,000 a year more for a couple $100,000 less in leverage, and that's where we play well. The couples market is where we shine, in all respects. And I have some other pricing models to share with you. Just keeping an eye on time. All right. Other features that I think are important for you to be aware of. We have lifetime benefits as well. We have a 2-year, 3-year, 4-year, up to 6-year durations, but we also offer an unlimited benefit. And I will say, we just got product approved in Montana this week. So now the only state we're not in is New York. We also have premium flexibility. You can go life pay if you want. That's what most people do. But we also have a 10-pay option, which is actually guaranteed. So while you're making premium payments during that 10-year window, it's a guaranteed 10-pay. It will never change. So it's non-cancelable for a non-can policy, as well as a single pay, right? So we get a lot of play off that 10-pay for higher net worth clients and also for executive benefit plans. As a traditional carrier, we're the only one that will permit 1035 exchange from a non-qualified life or annuity product. That's a unique twist in the traditional market. And we've already talked about a product built for couples. That's our market. When you look at our pricing at the individual level, we win a few, we lose a few. But when it comes to couples, it's really hard to beat. Now, one of the attractions to asset-based products is obviously the live, quit, die idea, right? In other words, you live and need long-term care benefits, you're there. If you die, there's a death benefit, which is basically a return of premium if you look at it from that standpoint. Or if you decided, I don't want it anymore and surrender it, you can do that as well. you can build our product through the riders, limited return of premium or full return of premium. Full return of premium is only available in California. Nobody sells it anywhere. It's too expensive. But you have the ability to build a return of premium product if you like, right? If that's important to you. Oftentimes, when you look at the cost of that rider, if you transition that cost to enhanced benefits, that's typically what people ultimately do. And that's an important thing to think about, because when we look at asset-based products, it's hard to break them apart and cost out their components, right? So with us, what you're able to do is educate your client on why it costs what it does to have a return of premium product, or a product, for instance, that provides a death benefit. You add that rider in, show the significant price change, and then you can say, there, you can be just like an asset-based product, or I can save you, almost 70% in premium. We can either add more benefits or save you a lot of money, right? Anyway, we can build it that way. And then finally, we also have a worksite program that's particularly attractive, I think, for executive carve-outs. Let's take a quick look at that. The issue age in our policies is between the ages of 40 and 79. Right now, it's an age nearest pricing structure. We only have one premium class for a group. It's called Unisex rates. So it's not a gender distinct pricing strategy. It's very attractive for couples, and especially for females, not so much for males, but it really benefits couples in a huge way, right? What's nice about our program, it's very low bar to entry. While we say a low minimum participation rate, 2 to 5 issue policies, that's what we look at. On a state-by-state basis, what validates a group with us, not is how many employees are there, but did you issue at least 2 to 5 policies? Michigan, it's 3, California, it's 3, Washington, it's 5, Texas, it's 2. It's a state-by-state thing, but we really don't care how many employees you have. What you have to understand, though, is that they're fully underwritten cases. There are no underwriting concessions with our group plan. It's the only concession we're providing is basically price, right? So that's what's important to take home to the bank. I've been in the group space many years myself, so I can be really helpful to you if you come across a client who either owns a company or who runs one. They typically have executives who want to take care of. I think of high-end property and casualty firms who have commercial accounts. That's an executive carve-out market opportunity, right? So anyway, I won't spend a lot of time there, just making you aware that that's available. I want to touch on underwriting really quick, because this is kind of the boogeyman, to many when it comes to long-term care, because they think you can't get anything approved. And, frankly, we're seeing probably a declination rate running about 22 to 25%. So, over 75% of the market is still getting approved. So people do get approved for this stuff. But what we have, I think, is a unique situation in that we have a very high-touch underwriting department and a very robust pre-qualification support structure in place. So in other words, I'll show you in a minute, you'll see our form, but we really believe in helping our agents assess up front whether they have a good case or not. Many times, especially agents who are new to our business, will say, I've got a 42-year-old female non-smoker, and she feels great. I may say, what else do you know about her health? Because we're looking at medical records. We're also conducting a phone interview when that application comes in. You do have to really make sure you've done your due diligence as far as field underwriting, and we can help you with that. We talked about a seasoned underwriting team. The average tenure of our underwriters is 15 years. This is interesting. 60% of our pre-quals are advised to submit. So the majority of people that come in, once we help the agent flesh out the scenario, we will suggest that they submit. We won't suggest if there's a clear reason why, and that's why pre-qualification is so important. We also have a very robust appeals process. In other words, if a case was declined and you're convinced, because you really did your homework, that we got it wrong, If you can provide additional information for us to look at, we will look at it. When we get a declination that goes into pre-qual, that goes into an appeal, that appeal lands on the desk of our vice president of underwriting and new business and is discussed between our medical director and our head underwriter. We do that especially for cases when it comes to major depressive disorder. About 20% of our declines are overturned in the appeals process because we give it a fair shake. So that's really important as well. Now, as far as the underwriting process itself, our average turnaround time is about 28 days. We do go for full medical records on all applicants. When an application is submitted, we do have an electronic app, or you can upload a PDF fillable app. Once we receive that application in-house, our own people are then reaching out to your client to let them know that the application is in-house, and we just want to verify that we have it all straight on our end from terms of the application and the information contained within it. That is the phone interview. That happens on all applicants 65 years old and younger. If you're 66 years old and older, we do an in-person, face-to-face assessment, cognitive assessment. Face-to-face is important because we can tell a lot by someone's home, whether there's disarray, whether there's early signs of dementia, cognitive impairment, just looking at the place. But everybody at that age segment, 66 and older, has a personal, in-person, face-to-face interview. Now, as we're winding down this presentation, just a few more slides, I'm going to share with you some common areas where we see most of our decline activity. And this should give you some clues when you start interviewing your own clients about long-term care. Number one reason we're seeing declines these days is due to obesity with comorbidities. Obesity with heart disease and diabetes or other factors, right? Congestive heart failure, things along those lines. Heart disease is a big one. And when we talk about things along those lines as it relates to cardiovascular health, diabetes is really important, and I'll touch on that in a moment. But obesity with comorbids seems to be the most common area where we see declination activity. And when you look at our height, weight, and build tables, they're pretty doggone liberal, if you ask me. I mean, when I see basically the limits, I'm thinking those are pretty generous limits. Memory complaints is another one. When you talk to your client, they're going to get that phone interview. Really make them understand that this is something they don't joke about. Or if we get if a call comes in, we make our call, and the applicant says, I tell you what, my short-term memory is shot these days. I just don't remember anything. That's the kiss of death when it comes to long-term care. Memory complaints is the second most common reason. The early onset of dementia, of Alzheimer's, and senility is an issue, right, that you want to think about. Now, let me talk about cognitive impairment here real quick, because family history is an area where we have evolved a lot in terms of our openness, right? So when you come across a client and there's a family history of dementia or Alzheimer's, if it's only one, we don't care at all. If it's two, the bottom line is if that cognitive impairment was diagnosed at the age of 75 or older, that's okay. We're going to still underwrite that applicant, even with that family history. If it's younger, we won't underwrite that person. If it's the early onset of vascular dementia, something along the lines of Bruce Willis, for instance, or if you know who any of the famous sports history like Fat Son, perfect example, early onset of vascular dementia in the late 50s, she died at 65. It's a very aggressive cognitive situation. That's where we draw the line on family history. So hopefully that makes sense. Major depressive disorder. Depression is at epidemic levels these days. Everybody's depressed, it seems. And I think we're getting a better understanding of depression. But major depressive disorder is often, it's identified as a medical code in medical records, and oftentimes is overprescribed as a diagnosis, if that makes sense. What major depressive disorder is really all about, it's truly debilitating. And you can't function, you can't work, you literally cannot function. It also portends to the early onset of some form of cognitive impairment. The fact that it's debilitating in nature is a problem in itself. So with that, if we see a case that comes in and we see in the medical records major depressive disorder, MDD, right? We used to just flat out decline them. We don't anymore. That was and again, it lands on the desk of our vice president of underwriting and new business with our medical director and our head underwriter. They discuss that case on its own merits. Is the person still functional? Are they still working? Are they truly majorly depressed? Or was it situational? Maybe they battle with depression but are highly functioning. All of that is okay as long as that person's functioning and they're not debilitating. So when somebody brings up, or you should ask about depression, if they have it, dig in a little bit, find out, was it caused because of a death in the family or a business failure or some sort of external circumstance? Find that out, because that's important, because that's a person that's probably still insurable because it's situational in nature. This is an interesting one. Undisclosed conditions, of course, especially excessive alcohol consumption. This one is interesting because if somebody says, you know, I don't drink much during the week, but on the weekend, I'll have a case of beer. I'll have 10 to 12 beers on a Saturday when I'm watching football or baseball. That falls in the category of binge drinking. We don't like that. If we see in the medical records, the doctor recommending that the client stop drinking, and if there's evidence that that person has been compliant with that, fine. But what we have found in many cases, and this is again a phone interview coaching thing, really get down to what are their lifestyle habits, especially around drinking. Smoking, we don't care about, but drinking is interesting because some people think, well, I don't drink a lot, but then they'll go on a bender on the weekend, right? So that's an important thing to dig in on a little bit as well. Finally, last but not least, diabetes with comorbidities. With us, I would say this is one of the areas where we tend to be fastidious, right? If somebody is diabetic, and you get the complaints over the years, it's the deterioration that takes place in someone's cardiovascular system is very pronounced and ultimately leads to strokes, dementia, vascular dementia, things along those lines. So if somebody is a type 2 or type 1 diabetic, and this is the important thing, and they've had heart surgery, bypass surgery, heart attack, that's not a good case for us. Even if maybe they had a single bypass 20 years ago, if they have diabetes, that is not a good long-term risk for us. We see that as a future risk. So that's an area you also want to look at. These are the areas where we see most of the decline activity. And I will throw this last one in, even though we're not saying it here, we do say it at the bottom. Sometimes people lie to you. And you just, like when you see a decline, you say, I just don't get it. I mean, they told what they told me, and what you guys heard me tell you is fine. Well, they didn't tell you everything, right? And we ultimately find it in the medical records. And there's a box in our application that you want to make sure you check that will allow you to see the reason why the decline happened. Now, if it's something really sensitive like drug abuse, alcohol abuse, addiction, we may not even tell you that, but at least we will tell you, well, this is kind of what happened. So it's an important thing to also keep in mind. So with that, getting at the end of the situation here, we have a pre-qual worksheet that you want to utilize, right? We have that is a great place for you to go. Also, and you send it in, and we can tell you whether you should submit or not. And then our agent resource center at 888-505-2332. That's another great resource for you for underwriting and new business. But with that, Kristie, that's all I have today.
Awesome. Well, to tell you, we do have a couple of questions here. So one of the agents have asked, does the joint policy allow for better underwriting if one partner has issues?
That's a great question. And I would tell you a couple of years ago, it did make a little bit of a difference. Not so much anymore. We pretty much look at it as an equal situation.
So individuals are being underwritten, no matter if it's a joint or not.
Correct.
Okay. Okay, good. And then how many years after cancer will the underwriter look that
That's a
is
great-
required?
Depends on the kind of cancer. Some cancers have an incredibly high cure rate, like breast cancer, prostate cancer. We typically look at a 2-year window at a minimum.
Okay,
And then from that, then there's the kind of cancer and the staging and all that. But
sure. Okay, that's good to know. So I have a question. With your, once an agent is appointed, will they have like a underwriting guidebook or field underwriting guidebook, or just some more in-depth things about the plan, about things surrounding underwriting and that sort of thing?
Oh yeah, we have all of that. We have an agent guide, an underwriter. We have lots of guides. And
Okay.
our website is very robust and user-friendly. You don't even have to be appointed to get access.
Oh,
to
nice.
it. You can actually download sample policies,
Okay.
writers document, all that. It's a great site. All our marketing flyers there.
Oh, that's great. That's good to know. So it's also good to know about that you are in the work site and you do have a low minimum in the state of Michigan. And I'm assuming that each state has a little bit different requirements on that, but I see an area where agents will introduce this will be in small work site type of environments. Just because, as we talked about in the onset, that model going to, a mandated tax for long-term care in the state, this might be something that an agent might likely introduce this to. But any other questions out there, go ahead and type them in the Q&A portion, and I will be happy to read those off. It doesn't look like I've got anything popping up just yet. Oh, and then how do we get appointed? So we are just newly appointed with NGL, and we will take care of that appointment process for you. Just go ahead and send over a quick email. You can reach me at kstrauss@iadbrokerage.com and just say you're interested in getting appointed, and we will kind of take it from there. Commissions and that sort of thing. We'll let you know what all of that is. So perfect. I don't see any other questions. So Larry, thank you so much. We're really excited to jumpstart this relationship, and stay tuned, everyone. This is a recorded webinar. It will be on our YouTube video station. So if you wanted to go back and listen in again, feel free. We're looking to have a follow-up to this webinar. Larry is looking at bringing on Norman Seaman, who has quite a bit of experience in both underwriting and in claims with NGL. So he is going to partner with Larry, and they'll have a nice sort of like dialogue, more like a, what did you call it? Like a podcast scenario. Yeah. So stay tuned for that. We'd like to have that in the next couple of weeks just to follow up. And as I said, in the meantime, feel free to call and we will get you started. All right, everyone. Well, thanks so much again. And Larry, I'll be talking to you.
Thanks for having me. Have a good day.
You bet. Okay.